Hello, hello. Good evening. Boa noite, meu amigo Ron. I hope you guys are well. Having a good time so far this week. And let's get started. Okay. All right. So today we're gonna talk about investing's third dimension, neglected at your own peril. Well, what's the third dimension, right? The title might be a little intriguing, but as you'll see, the most um, neglected uh, aspect of investing often, all right, especially for us stock investors. All right, it's we're gonna take a deep dive into it. All right. So just a quick update for the RISP 500 indicator. Um, So this week, actually, this position is as of today, August 13, and the S&P 500 now is about 10% in a year. And our strategy is the one that's returning the best this year is the strategy 7 based on Nasdaq, 34 and a half. Strategy 6 based on the S&P 500 is about 30%. Um, for the 3.5 year period, strategy 7 and strategy 4, both based on NASDAQ, are next to 300% more or less. Okay, in 3 years and a half, 3.5 years. And and all strategies are really crushing the S&P 500 during the period. Okay. All right. I just wanted to share something kind of exciting. We're building here the tool, um, one that's going to come online at some point. We're still working on it. Uh, is the RISP 500 in real time. Okay. It's going to be available all day long. And I'm going to show quickly. Um, I, I recorded so you can see it here. Okay, so with time, as time goes on, it plots the charts, and at every moment we'll have it, running. Okay, so this is just a quick demonstration. That's all. All right, perfect. So uh, we're making improvements over here. Perfect. So again, just to reiterate, the goal of the club is to accelerate wealth through education by maximizing return to risk ratio and outperforming the S&P 500 every year. So the risk 500, the goal of it is to help us achieve this goal. Okay. And today's topic, as we said earlier, is investing, third dimension, neglected at your own peril. Okay, so let's get right into it. So, what are the three dimensions of investing? The first two dimensions are well known: the return and risk, right? And um, as you can see, basically, we plot on the chart. We can see graphically stock A and stock B with a different risk and different returns, right? Usually, you would expect a stock that has a higher risk would return better than the one that has a lower risk, right? That's usually what it is. And we build portfolios this way, right? But incredibly, many advisors, when they meet clients, this discussion is not even discussed. They discuss, well, you have a, you know, s- stock A, stock B, or stock C, whatever, and we expect those stocks to do well because of A, B, C, D, right? Different reasons, but I rarely see any advisor discussing with clients what the risks are, what's the uncertainty around achieving this return, right? So, most people, including Wall Street, is very, very focused on return only. All right. So we're gonna show here just a few. popular methods that where it's basically unidimensional, only focus on return. A- and we're going to show also some approaches that are two-dimensional, and then we'll talk about the third dimension. Okay, so let's start with the unidimensional. So stock valuation, for example, when you do a fundamental analysis on the stock, often you get, when you estimate the value, sometimes you could use, you know uh, discounting uh, future cash flows, right? You can do that. That's one way of doing it. Basically, you're going to the company, you're gonna make some assumptions, and from the previous year to the next year, what's the what's going to be the revenue, what's going to be the cash flow, what's going to be the expenses, all that, right? And then you'll come to some conclusion, and and you're going to do the valuation of the company that way, right? And with that valuation, then you will look at the market and say, well, is the price in the market being traded, that level, would that level be higher or lower than the valuation exercise that you just did, right? If it's lower, well, probably the stock is undervalued, overvalued, so you'll make your own conclusions that way to make your investment decisions. That's pretty much how it what what's done. But then you're not talking about risk really here, right? So another way to do a stock valuation is with the PE analysis. It's a much easier way, I would say. But anyway, it will also depend on some fundamental analysis, because you have to come up with a forecast for the E, right? The E is in the denominator of the PE ratio. So the earnings, especially these forward earnings, or you can do also over, trailing 12-month earnings. But if you want some like forward looking kind of analysis, you have to forecast earnings, right? How do you forecast earnings? Probably you're going to have to do a fundamental analysis anyway, right? And then usually there's a way to do this. A lot of people just compare the PE ratio to averages or past averages, like 10-year P ratios. I'm one standard deviation or two standard deviations of that number, and we tend to think that probably the assumption is that the P ratio will converge back to some kind of mean, right? Some mean reversion. That's what usually is behind the assumption behind this kind of decisions, because then we will look at it and say, wait, this is overvalued, this is super high, like in the 2000s, the P ratio went up too much, and then it had to come down. Anyway, so that's again, here you're very unidimensional. Okay, you can also use the Buffett indicator. In this case, you're basically comparing the market cap to the GDP, right? And also the same thing, you have this like historical trend line, which is like an average, that's growing average, because the market goes up, uh, market valuation goes up with the market, right? And that divided by the country's GDP, right? So also you do the same thing. You calculate, historical standard deviations, one standard deviation, two standard deviation, and you look at the past. In the past, when it reached the two standard deviation, it came down, right? So that's one way of doing it, right? So not just another way. So again, this in the same this the same way that we discussed for the other two. All right. Also valuation. We're also, again, in valuation, we can do different things here, right? So here is we're just looking at the index concentration here. For example, you see the mega cap US equities, like the mag 7, right? The magnificent 7. um, they dominate the index. And right now, if you look in terms of valuation, they look expensive relative to the rest of the market. Okay, so that's also valuation. We're not talking about risk, we're just thinking in terms of returns. Okay, now another popular method that is very unidimensional is the buy the dips, right? So when the market is coming down, you start buying it, right? Every time it makes a new low, you buy, right? But then we don't know until how long, right? It's just going down and down, and you're buying more. So I'm gonna show this example. I showed this example before in other meetings, but I always think it's good to come back to it, and I will follow this stock for a while. Okay, so you can expect me to go back to this example more times in the future because I'm watching this guy, or I'm watching this guy. I think it just makes a great example. So this, United Healthcare, right? It went down. It was like, from 600 level, it went down to 300, and now it's about 250. It went down even more. Okay, so this chart is already kind of outdated. It's from June, so yeah, it is outdated. All right, this one, the portfolio balance rebalancing is another technique that's very, very popular, and usually fund managers and um, family offices, I mean, professionals, advisors, they do something similar to this. Um, what they do is, they have some target in mind, some allocation target in mind, that they want to maintain that allocation, right? So, that the allocation at the beginning, for example, this one here, right? So, like, we're going to have 40% allocated to domestic stocks, 30% to foreign stocks, and 30% to bonds, right? But this is only at the beginning, at one certain point in time, because as time goes on, you know, assets appreciate, depreciate, right? Prices change. So this the percentage allocation is going to change, right? Certainly going to change. And what they wanted to do here is basically to bring back to the original allocation. So, for example, if stocks went up, I'm going to sell stocks. For example, went up. So domestic stocks, let's say that domestic stocks went up a lot. Foreign stocks also went up, and bonds didn't. Right. So of course the pie chart is going to change, and the goal is to, you buy the bonds and sell the stocks to bring it back to what it is. Right. So you have the cycle here. So if stocks um, gained in value, you're going to sell high, right? And then the bonds, you're going to buy low. That's the idea, right? So you sell high and buy low, right? Okay, so here we're we're, we're talking about two-dimensional approach because it is also considering risk, even though they're not really calculating risk here for people to see, what's the risk that you're incurring investing in domestic stocks or foreign stocks or bonds. We don't know, right? We usually don't know. When you speak with an advisor, usually they will talk about returns only, right? Prices and returns. Okay. But but in the back of your mind, you know that this is for, this they made this to consider risks as well, right? Return and risks. Okay. The other two-dimensional approach, which is similar, which is, just diversifying a portfolio of assets, right? You diversify a portfolio with different assets, like the traditional 60-40 portfolio. You have 60% stocks, 40% bonds, or an all-weather portfolio. It's actually is the same idea, but just you have more types of assets in it, right? And also the target date funds for people, for young people, for mid-age people, and older people, right? So they will change the allocation of stocks to bonds ratio. It's going to change a bit as a person ages. But but still, you are here is similar to the portfolio rebalancing. You are basically considering the two dimensions, return and risk. Okay. Okay. So what is the third dimension? The third dimension actually is time. Okay. Time, unfortunately, is the variable that's most um, neglected. It's the most neglected. Most of the time, people will make their investment decisions without thinking too much about time, and I will show you guys how. Okay. So that chart with the return and risk chart, we have to add a third aspect for time. All right. So stock A and stock B, they are not static on the plane, on the return risk plane. It moves, right? It moves across another dimension, which is the time dimension. All right. So the stocks are going to move, and the way they move, has uh, extreme implications on returns. All right. So all three variables, they're bound together. All right. Okay. So why, right? Why this is happening, right? So let's take a look at the formula for future value of an investment. What's the formula? The formula is future value equals a present value times one plus the rate of return to the power of time, right? The time is in the exponent here, is exponent here. All right. So what are the where's the risk? The risk is the uncertainty around the risky market. So let's say if this is a stock market return, rate of return, right? It's you don't know if it's going to be 6%, it's going to be 8%, 10%, 12%. You don't know, right? Especially at the beginning. You don't know how much your money, which is here in present value, is going to grow. You have no clue, and that uncertainty around, um, the expected value is what we call it risk. So that's the risk. So risk is in here. It's in the formula. So we have all three dimensions here. So first of all is we have the rate of return, the risk, and time. So all three are here. Okay. What happens in practice in the market is that most investors, professional and um, non-professional alike, we're always chasing rates of return, isn't it? Are we not? Because most of the time we're like really concerned. We want our wealth to grow at a certain speed. That's what we're after. But then there's two variables here that are just as important, right? So risk is absolutely important. Doesn't matter if you have like 1,000%, and you're gonna find the next biotech company that's gonna, has a huge potential for growth, but it also comes with a lot of risk, right? What if it doesn't materialize, right? It's not a blue chip stock, or some stock that's a household name that already. It's a brand new startup, right? You have a great rate of return, but you don't know anything about risk. Probably it's very high. Okay. And time. So sometimes we neglect time so much because we're busy chasing rates of return. But just remember that higher returns come with higher risks, right? It has to. So, but time, it doesn't come with more risk or any downside. So we're often so focused on rate of returns, and sometimes we know about the risk, sometimes we don't, but everybody forgets about time. All right. So this variable is truly powerful, and time is limited, especially for us investors. We're humans, right? We don't have unlimited like time in this world. All right. So the time available for investments is finite. Okay. All right. So let's focus on time today. So the topic of today is time. All right. How can we make time work in our favor? That's the goal. Okay. All right. So let's find out how important is the consideration for time, right? How come? Let me start with the question, right? How come not everyone is a millionaire by the time they retire? I'll give you an example. Let's say someone has an age 18, very young guy, has a small income, right? 25,000. Its annual income is by no measure a great income. And let's see what happens until age 65. He will have 47 years. And let's assume he's investing at only 5% per year. Okay. 5% per year. Assume it's constant, 5% per year. 25,000, which is not a lot. 47 years is kind of a long period of time, right, for investment horizon. And let's see what happens, right? If this happens, if he invests all this money, investing all his income for 47 years and 5% per year, he's gonna get 5 million, right? What if he's investing at zero, right? Not 5%, but zero. He's just getting cash, put the cash under the mattress, and just wait. 47 years later, um, all the money that he got should add up to 1,175,000, right? So how come not everyone is a millionaire by that time? By that time, because if you look at the reality is, let's talk about baby boomers, right? Older people around, what their savings are. 37% of Americans have less than 50,000 saved for retirement. Okay, 37%. It's huge, right? And so on and so forth. You can read at the table here. But over 500,000, only 15%. All right. So the majority of people, this is really not the situation for most people. And why? Okay. Well, where did all the money go? Because this money did come through your hands, right? Even if you are working at $25,000 annual income, which is small, right? And 47 years, a long time, right? You should have that much. Well, of course, living expenses, right? Lifestyle. The money is gonna go out, buy groceries, pay bills, right? Rents, taxes, interest and fees, right? Credit card fees, interest, mortgage interest, right? Inflation is gonna eat away some of that money. Litigation, well, yeah, we're a litigious society, so there's gonna be um, money lost to litigation. Loss of employment, right? We're not always employed. Health problems, right? Etc. There's several things here that I call wealth eroding factors, right? So these things, inevitable, these things will happen, and these things will erode your wealth, basically, right? So money is spent, clock is ticking, and the time available for investments is actually shortening with every passing day, right? Every day you live, there's less time for you to invest, and time is finite. So, this is something that we really need to pay attention to, okay? We have to consider time. Okay, just to magnify the sometimes it's hard to see if time is very short, you can't see it. So let's magnify the problem, right? Magnify by it's like crazy. All right. So you're also showing here the power of compounding earnings, basically, right? So let's say you have $1, and in 20 days you're gonna, let's say the $1 is gonna double every day. Right? It's crazy, but let's just assume that is, because we want a very extreme example to magnify the effect of time, right? So every day it's gonna double. So $1, 2, 4, 8, 16, 32, and so on and so forth, right? So in 20 days, that $1, you have 100% rate of returns, 100% per day rate of return. You're gonna get after 20 days $1 million, basically, right? But what if On day 15, you got $32,000, and you say, you know what, I'm gonna take this money, to buy something, right? And then, I will restart with a dollar. Okay, can just restart with a dollar. Look what happened. If you restart this with a dollar, you're gonna end up on the 20th day with the same multiplier, the same investment. That's 100% a day. You're gonna get only $16, right? Where did that money go, right? The cost of interrupting compounding earnings has a cost, right? So that's how time is important. Okay, that's how time is important. All right, because with time, compounding earnings will snowball, starting from you know larger and larger bases to calculate your next return, right? Because you're starting from a lower base, you gotta wait again all this time to get to that point. So if you waste time, um, is a big deal. All right. Of course, this is a magnified example. I know that, but it just to illustrate the point. All right. Okay. Another great example to illustrate this point. So we have two scenarios here. So this person here on the top, he started saving $1,000 a year for 10 years from ages 25 to 34. So this little period here of 10 years, this period of 10 years, that's all he did. All right. For 10 years, he saved $1,000 a year for 10 years, right? So the total investment that he made is 10,000, correct? And after his 25th birthday, he stopped investing, right? So he's not investing anymore, just invested for 10 years. That's all. And let's assume the economy allows him to get earnings on a 8% a year interest, right? So when he reaches age 65, right, he will have 157,435. Okay, he only invested during 10 years. All right. Okay, the second person here on the bottom, he missed the he missed the train, right? He hasn't done anything at age 25. He waited 10 years, right? So during this first 10 years, he didn't invest a single dime, right? At age 35, it started investing. It's the same thousand years, sorry, same $1,000 a year, but instead of 10 years, he invested for 30 years. 30 years, okay? So starting age 35. So that is a total investment of $30,000, correct? The first person only 10,000 because he invested only in the first period of 10 years. And this person here, the second person, invested for 30 years, okay? Let's assume the same 8% interest. Look at that, 122,346. Look, what's the conclusion? Is that if you delay, it just this little delay here, 10-year delay, all right, 10-year delay, it had to invest a lot more, 3 times more, same interest rates, right? But he can't even surpass the first guy, investing a lot less because he started earlier. Okay, so that's another way of seeing the effect of time. So time is really significant, my friends. It's really significant. So don't fool around. Okay, if you need to make investments, start today, right? The best would be 10 years ago, but if you haven't, don't worry about it. The second best is to start today. Okay, so that's the cost of um, there's time wasted. All right, so time is really, really important. People don't think about it. Here's this is an example also for this, right? So 8% interest, so 8% rate of return. Here we're assuming the same instrument, probably the same risk. You're not taking more risk by getting a better return, right? A better result at the end. in dollar terms, right? You're not increasing your rate of return. It's the same rate of return. You're not increasing your risk, just playing with time. Okay, so that's very, very significant. Okay, so let's just review some of the most popular methods that we talked about to see how neglecting time results in below potential performance. Okay, all right. So the first time neglector and the performer is the buy and hold for the long run, right? There's a lot of people doing this. There's a lot of people on pundits and on Wall Street and on the media, advocating for buy and hold for the long run. Okay, so here is an example of our strategies here, our 7 strategies here based on the RISP 500 and this Milgram method, right? They're all outperforming the S&P 500. So this person is basically the buy and hold for long run investor. And the lesson here is really in your face, right? Basically, the money that you could have made is actually a loss for you because this is a lost opportunity cost. This is how we call this loss in finance, is that if you have, instead of being a buy and hold, long-term buy and hold passive investor in the S&P 500, for example, right? Here we're talking since about 3.5 years, starting January 1st, 2022. Um, See, all our strategies outperformed by a lot. So this difference, this difference to this actually is a loss because you could have been here, right? Okay, if you had chosen a different method, all right? By choosing this method, you're getting this is the same as if you had lost that much. You got this and lost that much, all right? Okay. All right, so strategy one, where I'm going to talk about 2 strategies. This strategy one, it has um, it works like this, right? So strategy one is pretty much investing in the S&P 500 when the risk is low, and it will rotate to cash when risk is high. That's all it does, right? It measures risk, and if the risk is low, we're investing in high risk asset, which is the S&P 500 in strategy one, and when the risk will go up, and too higher than our tolerance level, we're gonna switch to cash. So basically, if you look at the chart here, right, a buy and hold investors is the in the is the blue line, and it ended the year of 2022 in the negative, right? It's almost minus 20%, 20% down, right? But strategy one, by doing this, it pretty much put a floor when the S&P 500 went down because it switched to cash, right? Switch to cash. So you see some the plateaus here. So the plateaus, several plateaus here during the year because it was a bear market year, right? So that's what happened. But in 2023, it the market went up. It was a bull market most of the time. So you see, then the difference starts to happen right here. Okay, the gap starts to widen. At this point, it's interesting. It just shows that the $1,000 that you hypothetically invested here, you finally got it back almost 2 years later. Okay, so you had to wait for 2 years to get your principal back. So, and this guy who were doing the strategy one, hey, he didn't have that problem. Okay, so at the same time, he has a better head start than this guy here. All right, so that's the effect of time. So basically, if you're a buy and hold investor, um, you if you're holding your passive investor on the S&P 500, hey, you're like 2 years earning nothing, right? And the worst of all is, suppose you are here, for example, right? You don't know when the market's gonna break even. You don't know, right? So you have zero control. You're really at the mercy of the market. All right. Okay. And if you, again, if you want to, if your goal is to accelerate wealth because you have some targets to achieve, like financial freedom or a retirement goal, or you want to buy a fantastic house or whatever your goal is, um, you can't be at the mercy of the market. It's like, I don't know if you guys watched that movie, Rogue Trader. It's I think it was starring Ewan McGregor. Um, he was, he's based on a real story, the trader who broke Barings Bank back in the 80s. It's funny. There was one talk. He said this. He said that in the past I used to control the markets. Now the markets control me. Right? He was he was in a situation where he was like, completely at the mercy of the market. So this is the same idea. Okay, if you are just buying and holding, you are at the mercy of the market. You have zero control, right? I'm not saying that with RISP 500 with Smigrum, you will control the market. There is nobody can control the market, right? But at least you can control a lot of things going on with your investments, right? You can't control the market, but you can control your investments. While here as a buy and hold investor, you control anything, zero. You're pretty much at the mercy of the market. All right. Okay, so how this happened? Because these plateaus reduce the drawdowns by a lot, right? So the the that year 2022, which was a bear market, right? The years when the market's going up, this is not a big deal, but especially when you encounter bear markets or crash or correction, this is where the strategy is going to work the best, right? Because it's going to avoid that downturn, right? When it's that's what happened. All right, so you see the drawdowns here got limited to something like 6%, 7%, perhaps, right? 8%, all right, no more than that. Whereas the S&P 500 had a drawdown all the way to 25%. Okay, so that will make a difference. Okay, over a long time, it's gonna it's gonna cost you. All right, so that's why on the table we got, that's 2022 performance. Year end we got 0.53, like almost zero, right? Almost zero. At least we didn't lose any money, but the S&P 500 lost 20%. Okay, so the lesson here is the loss avoided actually is a gain. All right. Okay. Well, the other underperformance, the time neglector, and this underperformance is the buy the dips. There's a lot of people following this method, and from different ways. Of course, there are different ways to do this, but I'm just talking in general, right? So, what usually goes on the minds of the buy the deeper, right? That person is usually thinking, well, I'm a smart investor, while others panic, I build wealth, right? I'll keep buying more, right? I will double down, right? I'll buy more, buying cheap and buying low, right? And also, they will use this argument here. Warren Buffett said, it's nice to use, right? So someone saying, like, to justify your decisions, like Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. Yeah, there's truth in it, right? But using this to justify this, I'm not so sure. But anyway, let's keep going, right? So I'm a patient investor, therefore, a winner in the long run. But the reality is, everyone has a loss tolerance limit, right? It's not infinite. Um, some will pull the plug at some point, right? We'll throw in the towel. You can't just like, some people like can tolerate 10%, some people can't. Some people can tolerate 15, 20, 50. What about 60, right? We'll get a lot of people nervous here, right? So it's, and sometimes when you pull the trigger, then it's already too late, right? It's already a big loss when you decide to pull the plug, right? And what if you never sell? Some people just think, well, you know what? Doesn't matter. It's raining knives, but who cares, right? Just buy and hold for the long run, right? No problem. We're losing. That's no problem. Market, they believe that the stocks will always go up given sufficient time. All right. Given sufficient time. The, the problem is here sufficient time. You don't know how long, right? It could be just like a week or two, or it could be years. You don't know, right? Usually, larger drawdowns require much longer times. All right. Okay, so here's the problem, right? Here you bought here, but the market will eventually turn around. Yeah, right. Yeah, it will turn around. It'll turn around and it will make a full recovery someday. The problem is you don't know when the someday will come, right? You got your money back, but how much time you wasted, right? You wasted all this time. And again, this time can be short or it can be very long. You don't know, right? In our previous meetings, we talked about the Nikkei in the Japanese stock market took 40 years, right? So you don't know. That's the problem. And while you are here, you're just nervous because you don't know how long you're going to wait. What if instead of recovering it goes down further a bit and until recovery? Who knows, right? It's a variable that you don't control. And as an investor, I know I cannot control everything. I cannot control everything. But whatever variables I can control, I should control. I think that's the best message for this. All right. Okay, so again, that example, right? The United Healthcare stock, right? Hey, came down from 600 to 300, and the analysts are saying buy, 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 right? A lot of people think, yeah, I should buy, and probably they are right in terms of the fundamentals. Sometimes some people were analyzing the stock and say, well, the fundamentals of the stock is very good, but it's losing, so I should buy because it will come up eventually. That's the problem. The eventually. We don't know when the eventually is going to happen, right? And while you are in the market, you are exposed to more risks. Just like a sniper, right? If you're a sniper, you know that you don't want to have your position known to the other shooters, right? So basically what you do, right? You identify a target, you'll find it, and then you know on your viewfinder you're going to get it, lock it, and you're going to shoot, pull the trigger. The moment you pull the trigger, what you do, you hide yourself, right? You're not going to be exposed, because if you're exposed you can be killed. Someone will see you and kill you. There's also sniper trading, right? Sniper trading is based on this principle, because the longer you are exposed in the market, the higher the probability that you may encounter a downturn, right? So you want to be in the market only when the odds favor you. That's what the RISP 500 does for you. It will give you the best odds for the moments you should be in the market and should not be in the market. Okay? So that's the main idea. But here is someone who analyzed the stock fundamentals. Well, fundamentals are good, but you can't control the time. So is it you should buy, right? So in this case here, this is what happened. It went down 50% from 600 to 300, right? And this person was saying buy, right? But just in a month, in a month or less, it went down even more. So now it's at level. It went to level. Oh, sorry. So actually here it went to 400 and then went to 300. Right. Oh, let's buy more. Right. Went down. Let's buy more. So buy the dips. Okay. So now it's like at level 300 to go back to 600. It requires 100% growth to get back here. All right. So the question is, how long is this going to take? I remember this. Yeah, actually, it went even lower, right? So that was in June. And then 2 months later, it went down even more, right? And I remember someone was saying in the forum about this, they're talking about, they said, well, hey, I'm going to buy more, right? They're going to buy more over here, right? So they're following their system. Their system is the buy the dips. The it went down, buy, went down, buy more and buy more, right? So they bought at these 2 points here, right? That they're thinking about buying now here too. The problem is that now at 240, it's now 150% growth required just to break even. Okay. So look at this. How long do you think it will take? I think this is the main question, right? And you have zero control. You don't control this. It's a variable that you have no control. You're really at the mercy of the market when you do this. Okay. All right. The other one is portfolio rebalancing. We talked about it, right? So what are the main problems for portfolio rebalancing? The first one is the time dimension is not even considered, right? You don't worry about time here, right? You balance because prices have changed. So the relative prices have changed. So the allocation percentages have changed. So you just wanted to bring them back. You're buying and selling, right? To bring it back. You're not even thinking about time. Time may be needed to realize maximum growth potential. So let's say if the stocks went up, right? Bonds went down, and you know, so now it's the equilibrium needs to be restored, and you're going to sell the stocks. But what if the stocks still have legs to go, right? What if it still have a potential to keep going up more, right? You don't know. You're just killing it because, oh well, because the allocation changed, so I have to sell the stocks, right? So maybe you are just leaving a lot of money on the table, right? You're just throwing away, because the only guideline here is asset relative value in the portfolio. We're not using anything else. We're just like a little robot. um, you know, yeah, actually, a robot could do this, right? You don't need to be someone with intelligence to do this because you already determined that your allocation are going to be this way, right? So you just simply execute. That's all. Another thing that I think is worse in this case is, in my opinion, is that you're always selling your winners. So if stocks went up, it's great. It means that you selected the right stocks, right? They're winning, but you're selling them. And you're always buying more losers, right? The bonds went down. Hey, let's buy more of the losers, basically, right? It could be the other way. It could be that the stocks went down and the bonds went up. So you keep buying the losers. I know what they say when they say, well, because you're selling high here, buying low here. Well, this is all very relative. Well, first of all, it's very relative. High and low relative to what? High relative to price yesterday, but may be very low to the potential price that stocks could achieve, right? So that's not selling high, so that's really like, that's why I don't like this strategy. And another thing, that's the first thing. The second thing is that you when you're selecting stocks and bonds or whatever assets you're selecting to build your portfolio, you are essentially betting on the assets you chose, right? And you don't know if they're going to perform well or not. But with time, you're already seeing that some stocks that you picked, hey, it's doing well. So that's proving your point that you made a good selection. But just because it had some success, you are selling it, right? So I don't think it's a good idea. But anyway, a lot of people do this, even professionals. All right. And next is what guarantees winners have that they already maxed out, right? They already reached their maximum potential. We don't know. There's no guarantees, right? And what guarantees losers can't lose even more, right? Who said that, like I'm buying more bonds because it went down? I'm buying more. What if it keeps going lower, further down? So I don't know. I'm not a fan of this kind of strategy. But anyway, so in summary, we talked about The third dimension, which is the time, often very neglected, but is very powerful. It can work both ways. It can, if you know how to use time in your favor, it can be great, fantastic. You don't add more risk to your portfolio, to your results, by working time correctly, right? So, and you can get a better result with it. So time is very powerful. It's very neglected. um, Sometimes people, when they look at this formula, they look at the rate of return. If the eyeballs come here, right? And usually time is really forgotten, right? Like, time is given, right? But it's not, and time is finite. All right. And we also talked about the this example here of the about the power of compound interest, which actually is a case of for time, right? And we also talked about this example here, where when you're in a downturn, you are essentially a prisoner, right? You're a prisoner of the situation. You're a hostage. You can't do anything. If you sell here, you are going to sell with a loss, and you don't want to do that. Sometimes it's better just sell it. You realize the loss and employ your money in better assets. That could be right, but most people will just hold on and wait until at least they recover their capital, right? Their original capital. And that's time wasted, right? Okay. So what to do, right? What are some solutions? So my answer to this is, you know, methods that don't neglect time, right? Those methods I think are more powerful than those that neglect time, right? That time is not important, or that kind of things. All right, this Meager method, based on the RISP 500 indicator, it will diversify across time. Okay, it's a tactical investing based on risk. It's very different. So it's an allocation that changes over time. Pretty much is the right moment to be bull in response to the bull market and the bear market. Okay, you create market timing. When you're in a low risk environment, usually the market is going up, so you are gonna focus more 100% that of 60/40 all the way 60/40, regardless of the market going up or down. Here we are going, is a context dependent as a kind of location. We're going to allocate 100% stocks when the risk is low, and 100% to bonds when risk is high, right? So we are really diversifying across time, right? Not just across assets and fixed over time. We are diversifying across time, all right? And which is actually very different from static portfolios based on diversification of assets. And it's very static, it's not going to change, right? Okay, so the allocation you want to keep the allocation fixed, and you can change some assets, but you want to keep the allocation fixed, right? So that's the difference. um, and there's a very important question. Sometimes people ask me, right? So why the RISP 500 Smeaker method works, right? Based on the RISP 500, what can you summarize it for me, right? How do I know it's time to buy or time to sell? Right? How do I know that, right? Actually, it's not that hard. There are just only two situations. So the first one is when the potential incremental return is worth the incremental risk I'm taking, I will hold the risk asset. All right. So for every little extra return that I want to earn, right, it's worth the risk because I'm going to take a little bit of more return, but I'm also taking a little bit more risk. If for me, given my risk tolerance level and appetite for return, it's worth it, I will hold the risk asset. And when the potential incremental return is no longer worth the incremental risk I'm taking, I will sell the risk asset. So that's why we have the RPT, which is the risk cutoff level, meaning that if the risk increased so much above my tolerance, I will sell it, right? I'm not going to hold it, right? And when the risk is low, right, within my risk tolerance level, I'm going to hold it. All right. If I'm not holding it, I'll buy and hold it, right? Until it, the potential gain is not worth the extra risk I'm running. That's pretty much that's the story. Okay. So this is putting risk management on the driver's seat. That's pretty much it. Okay. The, the risk management is gonna show us the way. Okay. And we take into account time. So all three dimensions are considered in this strategy. Okay, so these results speak for themselves, basically, right? So that's why we have been doing so much better than the S&P 500. Okay, just buy and hold, for example, right? Almost 10 times better in 3.5 years. All right. So again, so the first thing this method is to avoid crashes and any serious downturns, right? So we already seen this. This is how it works, right? So taking losses is not okay. All right. So here, strategy one is all about avoiding losses, right? So it will turn to cash every time the risk is either went high, and then we are gonna avoid holding risk assets. So taking losses is not okay, right? Losses of money actually equals loss of time, and vice versa, right? So what we're doing is here with strategy one is a solid risk management to accelerate wealth formation. All right, because if you keep losing so much, right, it's kind of one step forward, then two steps forward, and one step backwards, right? So it will create a drag on your speed towards forming your wealth, right? But if we avoid the losses, we can accelerate just by not falling prey to the crashes. It's going to help us accelerate wealth. All right, and the second is we're going to accelerate the growth in low risk conditions. So every time we're in a low risk condition, we want to accelerate it. So for example, here we have a low risk. We want to invest in the leverage version of the S&P 500, right? So the SSO, it will go up by 2% if S&P 500 go up by 1%, right? Okay, so that's why you see this is the what happened in the year 2022. It's a bear market, right? The S&P 500, we already saw it, went down almost 20%. But strategy six, by doing this, by rotating the assets dynamically, depending on the risk level we are, and matching the best asset for that risk level, right? We got plus 33% that year, right? Better than strategy one, right? Strategy one that year ended like flat, right? But here you got a winner, all right? So, and if you look at the risk, it's still below, even with this, it's still below the holding the S&P 500. All right. Some periods it went up a little bit higher, but most of the time, especially when it really mattered, it was much smaller. All right. All right. Drawdowns, very important. Okay, so that's why in the table we see strategy six in 2022, the year 2022, which was a bear market year, we got 33% plus positive, right? So here is the lessons are don't waste time, right? Turn time into an ally, because if you look at here, this person who were like just who was just holding it, buy and hold, right? He it was wasting time, and whereas here we're turning time into an ally for us, and again, solid risk management to accelerate wealth formation. That's the idea. Okay, so here just a overview how it works. We got the RISP 500 being read once a day. Okay, and then that will create for us the a timing mechanism, basically. All right, to avoid the big drawdowns. Okay, and where's the proof? The proof is every day I save this. I in social media. I publish on social media. It's a live track record, right? Because every day is updated. This is just an example that was in June. So, you'll see there's a timestamp by the platform. It's not something that I can mess up with. It's there just to prove that every day we're doing this, and we're also updating the track record. Okay. Okay. So here's the market today, right? And is it too high? What's going to happen, right? Oh, sorry. Yep. The truth is that there are arguments for bulls and there are arguments for bears, right? Arguments for bears is just like too high, right? It's already too high. Look at the PE ratios are all very, very high, um, you know, and with the tariff war, whatever, you don't know, right? So probably this will come down at some point, and some points very soon, because it's already overvalued by a lot, especially the high tech industry. There are many, many reasons for which the S&P 500 should drop and all the stocks will go down, right? But there are also arguments for the bulls. Since Liberation Day in April, the market has been climbing up, right? Little by little, just very low volatility, and just very gradually, and but it keeps climbing, right? So there are arguments for the bulls as well, right? So what's going to happen then, right? What's going to happen? The answer is I don't know. Honestly, I don't know. And I don't care. To be honest, I really don't care. All right. Why, right? And I don't forecast. I don't forecast because it's if I forecast, just like my guess is just as best as yours, as anybody else's, right? Nobody has a crystal ball to know what's going to happen, really, right? So what I do is I measure risk and I match the best asset for the risk level, right? If the risk measured is low, hey, I can go twice the S&P 500, twice Nasdaq, right? If the risk is high, hey, no, I'm not going to be holding risk assets. I'm going to, rotate to gold or cash or something like that, right? The safe asset, right? So it really depends. Okay. And I this way I will beat the S&P 500 every year. So that's just as a result of doing this. All right. Okay. So how easy is to use the RISP 500? It's very easy, right? So basically every day I'll come at around 10:30 a.m. New York time, right? Once a day, I'm going to take a measurement here, and that's valid for the day. All right. You don't need to know how it changed during the day. Unless you're a professional investor or you are a day trader, yeah. So this might be useful for you to know exactly what happened every minute, right? But if you are just a regular investor, you don't really need to know, right? That's fine. Every day, I'm going to send you an email. You're going to take a look at it. It's going to take you less than 5 minutes a day. Even if you don't need to pick stocks, you don't need to study stocks, look at the market to learn and find out what's going on in the market, the economy, or you don't need to. But it's great if you can learn, if you can find out more. It's obviously good. Education's always great, right? But if you are busy, you don't have the time to do this, or you have some important thing coming up, you're gonna get married, or you're gonna travel, life happens, and you're not there to to dissect balance sheets and that kind of stuff, which is very time consuming and really doesn't, it doesn't work better than this. And honestly, but you don't need to, right? You can just look at the email once a day, just a time to open the email, because most days you don't need to do anything. So the average of work here is only 2 to 3 trades a month. All right. That's the average. Of course, if in a market that's very choppy, that you have like a big volatility, you will trade more, because the system will be, triggered to take you out of risk more often in those periods. But most of the time, it's very calm. And sometimes there are like a month or two that I haven't even done anything. All I did was open an email and take a look at the, what was the reading on the RISP 500. That's it, because it's in a range that's fine. I don't need to do anything. All right. Okay, so I invite you to join our club. Uh, by joining the club, you will have access to the recordings of our previous meetings, and you have also the opportunity to test the RISC 500 to see if it's for you. Okay, the RISC 500 will help you time the market, detect and avoid market crashes early, beat the S&P 500 every year as a result, and what's most important for everyone is to accelerate your wealth. All right. So come join us, and test the indicator. I'm pretty sure you're going to be pleasantly surprised. Okay. So again, thank you so much for being with us today, and I'll see you next Wednesday. All right. Thank you so much, and have a good night. Thank you. Bye bye.